Yeah, I messed up. I hope you use this video to avoid the mistakes I made when investing.
I fight to live, I fight to strive. One day I'll have what I want in life.
Hello and welcome to another video. My name is Exo, and in this video we're going to be going over my portfolio and investing strategy. So by the end of this video you'll know my investing strategy, how it works, why I use it, who it works well for and who it doesn't work well for. So the first thing an investor needs to consider is their own goals and timelines. For me, I have a long timeline and I want a good deal of security, along with a focus on dividends. This is why I focus on blue chip companies that allow for me to have stability, and with my current career this works best for me, as being away I have limited access to Wi-Fi so I can't check my stocks regularly. So my dividend strategy works off the basis that, and this is by no way accurate, it's just an example. Say you buy Apple at £1, so there's my one share of Apple in my hand, and say that Apple then pays you £1 in dividends. Say you then reinvest this one back into the company. The next time you get paid out, then you got £2, and then you can keep doing this over and over and over, and then this just compounds along with the compounding interest of that company. That's when it becomes very alluring. I'll put on a graph on the screen now to show you more in detail what I'm on about with some more realistic numbers, and I'll also show you on my screen now on trading 2-on-2. You can see this kind of with the auto invest feature. I'll be moving the prices up and down. This shows you more of the compounding interest rather than the dividend reinvesting. So I'm going to put the initial deposit to somewhere where my portfolio is, and then the monthly is at a realistic level. And then as I move the year slider up and down, you'll be able to see the value go up. The black line is how much I've invested during that time, and then the blue is the compounding interest. And then this was with a 13% return, which is just based off the portfolio I have. Doesn't mean it's accurate. 10% would be nice to have year over year. Anything more than that is beating the S&P 500, so that's good. Did manage to beat the S&P 500 last year. I doubled it, so I was quite happy about that. So yeah, that's all that's showing is the compounding interest. So you can see it works quite well. Okay, so the next thing we need to consider is who this strategy works for. This strategy will work well for most people, but there's a select few that will work best for. Again, this comes down to mostly the timeline you have, as compounding takes time, and the dividends normally, depends on the company, they get paid out on a quarterly basis. So you'll have to keep waiting for that to get paid, and then you need to have time to get this to snowball. So if you're someone who's older or trying to get their late retirements in or whatever, then this strategy is probably not for you. You would want to do something more aggressive. But again, this is all up to you. This is just my advice, I guess. And that's exactly why I chose this strategy, as I have a long timeline. I'm 20 years old at the minute. Would have been nice to start investing when I was 1. That's what you'll learn when you start getting down the rabbit hole. So hopefully I have a few years to get this money to compound and snowball and just grow. Now this does take a certain mindset, as it's the long-term approach. So if you're someone who knows they're not very good with long-term approaches or waiting, then maybe you should do more of the, I guess, sort of swing trading maybe kind of side of things, or just buy more aggressive stocks. But then again, that comes with its own risk tolerance. So it's completely up to you. If you're willing to, any money you invest, you should be willing to lose, as there's always a chance of that happening. Okay, so some of the key things to look out for when investing in dividend companies is you want to do a very comprehensive background check on them companies. I'll show you in a second what I mean by that. But in essence, you'll want to look at not just the dividend yield, because having a high dividend yield, while is alluring, doesn't mean that company's going to do very well. You also have to look at payout ratios. If you take example AstraZeneca, they have a payout ratio of 200%, which means They are just blowing through their cash. If it's close to 100 or higher than 100, then I would suggest you stay away from it. You want companies that pay out dividends, but then reinvest money back into the business as well. So then you get a bit of growth and the dividends. Companies who purely do dividends, they are literally just trying to hold on at that point, to be honest. If you don't have money flowing back into the business, you're not going to be able to sustain the business. You need free cash flow. And if a company doesn't have these basic fundamentals, then it's a no good. Okay, so if we hop over to my analysis sheet, then I'll show you what I mean and what to look out for, and I'll give you a useful website to go on. They break everything down for you and compare it to industry, so that saves you a lot of time and effort, as trying to find out information on stocks sometimes can be very hard, trying to go through the annual reports and stuff like that. Okay, so as you can see on screen now, you'll see the company description. This is just a quick example of how in-depth I'll go. This company's for J&J, which fits with my investment strategies. It's a dividend-paying company, dividend king company, very stable blue chip company. So there you can see company description. You always want to find out what the company is about because I didn't know J&J did Listerine. That's something I found out. And then they do a multitude of other things. They're in so many different segments. They don't get hit as easily as other companies, as you'll see. They're not very volatile. And it just keeps going and going and going. And then I had some intrinsic value here. If I can zoom in enough to that one. There we go. So as you can see, the current price there of when I did this, and then you have the fair value. So as you can see, J&J at the minute is very undervalued, which makes it a very good buy for someone like me. It might not be for you, depending on your strategy. Has consistently gone up with dividends for the past 58 years. It's a good dividend yield, not the highest, but at least the payout ratio would be good then. Has good free cash flow. Not a growing company. It grows a little bit, but again, this is not my strategy. If you were into growth companies, then you wouldn't choose a company like this. Each stock will be dependent on your strategy, whether it's a growth stock or dividend stock, or any in between, or a mixture. The price to earning ratio wasn't very good. Profit margin was good though. Number of shares outstanding, the current assets to liabilities was good. All of this information I found on this website here, Simply Wall Street, a very good website. I highly recommend. You do have to pay to get it, but there is free trial that I'm doing in a minute. I'm trying to use that free trial to get all my stocks valued and all done. It says it wants 130 fair value. It's like at 500 at the minute, so not the best. And then this is where I'm just researching what a P ratio is, because I'm still learning myself all these different things. And the PEG ratio. If you want to read any of this, just stop the video and zoom in, whatever you can do. And then here's the earnings, the free cash flows, and then the forecast annual earnings growth. The company is a little bit behind the industry, but not by much. And then again, with the annual revenue growth, it's a bit behind, but not by much. And then I go on and on and on. Before I stop, there you go, short-term liabilities, long-term debt. Here's a dividend. You see the dividend's not as high as the top 25%. It's been stable. And then so this is all the in-depth analysis I'll do, and then I'll have a list of the companies I'm in. So the reason why we have to go so in-depth in this type of investing is due to the long-term nature. You want to be so confident that you won't have to look at the stock market in like 10 years. That's one of Warren Buffett's principles. If you're going to investment, you need to be comfortable leaving it for extended periods of time without worrying. Investing and speculating are two different things. If you speculate on a stock, you're always worrying of it going up or down with the price. If you're an investor and you've done your research like that I've just shown you, that in depth, or even more, then you're comfortable leaving that stock for an extended period of time. So then when I'm away on ships and don't have Wi-Fi, I can then go, it doesn't matter what the price is doing, because I believe in that company long term. It has a track record of weathering the storms. You can look back in history. It took J&J, the example, took a dip 2018, 2019, but that was the only time that I could see. And they've, even in that dip, they did not take out their dividends, so they had enough cash flow, so they're able to get through stuff like that. So that's why, as an investor, you have to be so diligent on doing your own research. If you're buying a hype stock, you're not an investor, you're a speculator. If you don't do your research, you're not an investor, you're a speculator. And don't get me wrong, I have my investments like that. I have my invest account, which is my ISA account, where I have things like Neo, Eddie Stobart, and EasyJet. There's reasons why I chose them stocks, but they're still more speculative. Okay, so that's going to do it for this video. Make sure to check out all my other videos. Check out the description for all the links to my Train 212 referral. Use that, get 1 free stock when you deposit £1. I also get 1 free stock. Check out all the merch down there. Check out all my socials. And I'll see you in the next one.
Tell me pretty lies, look me in the face. Tell me that you love me, even if it's fake.